Hi and welcome to Finder Investors. Today I'm going to be talking to you about how the stock market works, how stocks move around global stock markets, what stocks are, and how prices are influenced by supply and demand. Just a quick note, this is not financial advice, this is general information only. Okay, first of all, back to basics. What are stocks? Stocks or equities or shares are basically a part ownership of a company. So when you buy a stock, you're buying a part of that company, a very small part of that company. You buy and sell stocks with other investors on a digital marketplace. This is called the stock exchange or the stock market. Think of it kind of like eBay, except that you're buying and selling stocks from other people rather than, stuff you have lying around the house. Okay, so how do stocks get onto the stock exchange? Well, let's imagine a relatively new company that's been doing pretty well, selling, say, shoes. Even though the shoes are really popular with customers, the company doesn't have enough money to expand, pay for marketing costs, or hire new people. Instead of taking a loan out from the bank or going to private investors, the company has the option to sell its shares to the public by listing them on a stock exchange. This is what's called an initial public offering or an IPO. During the IPO, investors pay the asking price for the company's shares because they believe it's a winning bet. They think the company will do well in the future, so they invest now at a price that will hopefully go up later. This extra cash that the company receives from investors means that the company can expand, which will hopefully lead to more profits later on. Those profits can then be reinvested into the company so that it can continue to expand, or it could be paid out back to the investors in the form of dividends. And if you don't know what dividends are, don't worry, we have another video for that. I've added the link in the description below. Before I go on, if you like this video, don't forget to hit the like and subscribe button so that we can keep making more videos like this. Okay, so what happens after stocks are listed on the stock exchange? After the IPO, regular investors will buy and sell the stocks to each other. They're not actually buying them from the company. And you do this through a stockbroker or an online share trading platform. You can't actually do it yourself. If you eventually sell your stock for a higher price than what you bought it for, you make a profit. On the other hand, if you sell your stock for a lower price than what you bought it for, you lose money. The stock price will go up and down depending on how many people are wanting to buy or sell the stock. Low supply of stock and high demand means that stock price will rise. Low demand and a high volume of stock means that the price will go down. It's just like any other product on the market. Supply and demand influences the price of the stock. You can also think of it like an auction. Buyers and sellers in the market are constantly adding what price they would prefer to buy or sell the stock at. Once the stock reaches that price, the buy or sell order goes through. For every stock that is bought, there is always a buyer and a seller. So say you just bought a stock for $5. That means that there's someone else out there who thinks that it's a better price to sell at. People buy stocks depending on how they view the company. Most of the time, this is how they think the company will perform or be valued in the future rather than at the moment. So for example, it took Tesla 18 years to make its first full year of profit, which was announced in 2021. But despite the company having never made a full year of profit, in 2020, its stock price still rose by 700%. In other words, people were investing in the future performance of the company or the future value of the company rather than its current performance. Generally speaking, a company's stock price will fluctuate. The stock price is influenced by a number of factors, including corporate finance and performance, economic data, politics, market sentiment, and now more than any other time, social media. When news and financial reports show the company is performing well, usually its stock price will rise, and the opposite happens when the company is shown to be underperforming. On the other hand, negative news or sentiment towards the company will see its stock price fall. After all, you'd be less likely to buy shares and more likely to sell shares if you think the company performance is going to go downhill. By that same token, what people perceive might not actually be in line with reality. And at other times, the value or performance of a company might have nothing to do with it at all, as we saw with GameStop. In some ways, it can be a big casino of educated guessing. Okay, so there's a fair bit of confusion about how a company actually benefits or profits if its stock price rises. If you're not actually buying shares directly from the company outside of the IPO, do they get any additional benefits from its stock price going up? Well, yes and no. When shares go up, this increases what is called the market capitalization. This is the perceived market value of the company. This market cap basically equates to how the company is valued by investors. So although a company doesn't directly profit from its stock price going up or down, unless of course company management owns shares in the company, a higher market cap impacts how much it can borrow from the bank or raise from investors or other lenders. So for example, Apple, which has a massive market cap of over $1 trillion, would be able to get a huge loan from the bank to continue financing its future performance or its future growth. If its market cap were to halve for whatever reason, maybe because of market sentiment, this would significantly reduce how much it would be able to borrow from the bank. Companies can also launch a share purchase plan, which is when they list more shares on the stock exchange. They usually do this when the share price has been rising and set the SPP price at whatever that is. The company will then directly get any profits from investors that are buying those shares as part of the share purchase plan. Okay, so what are the major stock exchanges? In Australia, we have the Australian Securities Exchange. In the US, they have the NASDAQ and they have the New York Stock Exchange. What are the major stock exchanges? Well, there are actually about 60 stock exchanges around the world. In Australia, we have the Australian Securities Exchange, that's our main stock exchange. And then we've got a couple of other smaller exchanges, that's the NSX and the CHIEX. The biggest stock exchanges in the world are in Europe, the US, China, and Japan. So in the US, we have the New York Stock Exchange or the NASDAQ, and in the UK, we have the London Stock Exchange. We have the Japan Exchange Group and the Shanghai Stock Exchange. But you don't actually have to be based in those countries to buy stocks that are listed on those exchanges. To buy stocks listed in an overseas market, you need to sign up with an international broker. So a broker or share trading platforms that offers global stocks. Often you'll have to pay more to access stocks that are listed in overseas exchanges, but that's not always the case. These days, sometimes it can actually be cheaper to buy stocks that are listed in the US or Europe instead of your own country. It depends on the broker that you use. Like for example, in the US, it's much more competitive, so the price to buy stocks is often the lowest at 0 brokerage fees. That's it from me today. If you like this video, don't forget to subscribe and like, and leave some comments in the section below, and we'll get back to you. Thanks for watching.